Welcome, and thank you again for joining us for Connecting Values and Investments, a conversation on environmental, social, and governance investing. At Bartlett, we are really excited to host this conversation and partner with three very well-respected firms in this space. 2020 has been a year full of change, full of surprises that have really convinced all of us that it's time for us to make sure that we are revisiting what those core values are. And in this present moment, we said it makes a lot of sense for us to really hone in on what we are offering our clients and help them think about how they can connect their mission and values with their investments.
We actually got into this space to take a stand on racism and apartheid, and unfortunately we're still dealing with those issues today in our country. But we got into the space of socially responsible investing by launching an equity mutual fund with a formal prohibition against supporting companies that supported apartheid in South Africa. Now, our approach at Calvert has evolved from this exclusions-based approach to a principles-based approach, where essentially we're trying to direct capital to companies that are having a net positive societal impact, companies that are operating in a manner that's consistent with or promotes environmental sustainability and resource efficiency, that contribute to equitable societies and respect for human rights, and lastly, that offer clear and transparent governance. We have a dual mandate, that is to deliver performance and impact simultaneously, and that's by being thoughtful in terms of the companies we invest in, and then by engaging with companies to drive positive change in many pressing socioeconomic and environmental challenges.
Wonderful, thank you. Moving on to Heather Smith.
Good afternoon, everyone. My name is Heather Smith, and I'm the lead sustainability analyst at Impax Asset Management and the Vice President for Sustainable Investing at Pax World Funds. Impax is a leading sustainable and impact investor. We were founded more than 20 years ago, but the Pax World Fund history actually spans back to 1971, with the launch of the first publicly available mutual fund in the United States to use social and financial criteria in the investment process. At that time, that meant primarily taking an exclusionary approach. Today, however, we see our mission in much broader terms. That is, as a specialty manager focused on the transition to a more sustainable global economy. And Impax has developed a particular expertise in environmental and gender lens investing. We think that capital markets will be shaped profoundly by global sustainability challenges, particularly climate change, environmental pollution, natural resource constraints, and demographic and human capital issues such as diversity, inclusion, and equality. And these trends will drive growth for well-positioned companies, but they'll also create risks for those unable or unwilling to adapt. To navigate this transition, we need effective tools, and that includes fundamental ESG research. We offer 11 mutual funds as well as separately managed accounts that integrate ESG, but we're also engaged investors in regular dialogue with companies in our portfolios, and we regularly report on our stewardship activities to our clients.
Great. Moving on to Craig Sarenbach.
Welcome, everybody. Thank you for joining. My name is Craig Sarenbach, and I'm a wealth advisor and principal here at Bartlett Wealth Management. Like the other firms, we've been making socially responsible investments for clients for decades, over 40 years. And like Calvert and others, we have a long history helping clients and nonprofits align their personal, environmental, social, and governance values with their long-term investment goals. And historically, like has been said before, this was done with an exclusionary approach. We have tended to use individual securities, stocks, and bonds. Now the options are much more robust. Like Lenore and Heather said, there are many mutual funds that are using these screens to promote good behavior. In our conversations with clients and others, we've found that 90% of people care about these ESG issues, but most are unsure how to access the opportunity. And so we help clients execute on this desire to do well with their investments and also do good at the same time by promoting companies who are at the forefront. So we have a team of 9 that helps customize individual stock and bond portfolios, as well as partner with firms like Calvert and Impax on best-in-class mutual funds. As a firm, we continue to make sure that our research effort helps us identify companies leading the transition to a more inclusive and sustainable society. That's what we all hope for. Thanks again for joining.
Craig. Robert, over to you.
Good afternoon, all. I'm Robert Killens. I'm with the Greater Cincinnati Foundation. I'm Director of Special Initiatives. The Greater Cincinnati Foundation was founded in 1963. So for 57 years, we have been connecting people with passion. We provide a range of services to generous donors throughout the Greater Cincinnati regions. We serve 8 counties in 3 states. At the Greater Cincinnati Foundation, I'm tasked with supporting our donors and private foundation clients. We, in addition to the current clients, we're working to diversify our client base through initiatives like Giving Black Cincinnati, where we are studying the habits and interests of African American donors and encouraging them to participate with us at the Greater Cincinnati Foundation. They are also manage our Impact Investment Program, a program that we've been embarked on for almost 20 years now. That program's done about 37 investments of about $22 million, and that have involved not only our assets of the foundation, but we've involved more than 50 donor-advised fund holders and some private foundation to join us. And so I'm excited to be here with you today to join in this discussion about ESG and to share with you the things that we're trying to do to play our part. So thank you, Bartlett, for having us, and we're excited.
Thank you. We have quite the lineup here today, so we're going to dive right in. I'm going to start with a question on stakeholder capitalism. This is a new concept that is gaining a lot of ground, a lot of traction. I'm starting to hear more about it written in the media. What is stakeholder capitalism and how do companies achieve it? Lenore, let's start with you.
Sure. Thank you. Happy to answer that question. I feel like this is a sense of optimism that we can hang on to because there is all sorts of negativity that's going on. So stakeholder capitalism is a new form of capitalism, if you will, in which corporations of today and tomorrow seek to balance the needs of shareholders with the needs of other important stakeholders. And those stakeholders are defined as employees, customers, suppliers, and the community at large. And what's interesting is prior to this pandemic in 2019, the Business Roundtable convened, and that comprises of approximately 180 CEOs of some of the largest corporations. And for the first time in 50 years, they redefined the purpose of the corporation away from Milton Friedman's notion that the corporation should maximize shareholder value, shareholder primacy, to one that balances the needs of these multiple stakeholders. And certainly what's interesting about this pandemic is it's created a unique opportunity for companies to demonstrate their commitment to stakeholder capitalism. And quite frankly, how companies behave in managing their social capital is going to have a profound implication on the reputation of that company and their impact on society. It's going to have a profound implication on their reputation as a potential employer, the confidence that we have as consumers, and the overall strength of their brands. Now, this is certainly a bit of an oversimplification, but companies essentially have 2 choices in how they manage their ESG capital, but in particular, their social capital. They can exacerbate and lengthen the duration and severity of the pandemic by, for example, unfairly restricting paid sick leave or failing to provide a safe environment for workers and customers. Conversely, companies can do the opposite. In how they manage their ESG capital, and in particular their social capital, they can work to come up with innovative solutions to help address the pandemic and thereby shorten the duration and severity of the pandemic. Fortunately, many companies have chosen the latter approach, and that's because of their commitment towards this concept of stakeholder capitalism, where the needs of all stakeholders have to be balanced.
Thank you. Craig, how does Bartlett think about stakeholder capitalism in your investment considerations?
I think all of us believe in capitalism, in profits. Now and going forward, though, good business is going to have to be supplemented by doing the right thing for the collective society. You know, the wider community, whether that's local or global. It's workers, it's customers, it's the environment. A lot of this starts even more local at home, if you will. Lights, water, you know, recycling, all of it. And in light of what's been going on this year, certainly from an environmental and social perspective, it's opened people's eyes to perhaps the sobering reality that this has cost us, you know, whether it's Federal Reserve governors or Citi the other day, or many global institutions, including Calvert and Impax, are looking at what are the costs of systemic racism here in America and globally, and it's, you know, it's an unfathomable number, in the tens of trillions of dollars, and so it's imperative that we do this immediately. And the good news is that many people have been and are already affecting change by partnering with these companies, with local groups, nonprofits, to understand the challenges and then promote that positive change through their investments. You know, we see the flows in terms of where we see money going in the industry, and that is this year already, just in the first half of 2020, money flowing into sustainable funds totaled all of 2019, and 2019 was a 4x number on the previous record. So hopefully this is an opportunity for everyone to accelerate this change, and we are doing that for clients by, again, investing in these positive leaders and using ESG-focused funds that have a tremendous track record of performance and also are promoting good by not just making the investments, but meeting with those companies and in effect demanding that they do the right thing.
So Craig, you mentioned the interest in ESG has really skyrocketed recently, and we find that a lot of clients sort of find their way to ESG through a concern about the environment. ESG being environmental, social, and governance, and there's lots of different pieces of the pie that go into that. But environment seems to be a really key focus for many clients interested in this space. Heather, at Impax, how are you thinking about this environmental factor and incorporating it into your investments in terms of addressing climate change beyond just saying, you know, I don't want to own an energy company?
Sure. Well, you know, climate change is obviously one of the biggest challenges that we as a society face. And as investors, we need to be able to anticipate the risks that climate change brings and also use our investment tools to quicken the transition to a low carbon future. And, you know, as you said, we can't do that by limiting ourselves to divestment, but this really requires a very multifaceted approach. So, you know, first we need to think about mitigation. So effectively mitigating climate risk by reducing emissions, for example, means that risks for some sectors like energy, like automobiles, are going to be amplified by alternative technologies like solar and wind power, as well as electric vehicles. Second thing we need to think about, though, is adaptation, because no matter how good a job we do at mitigating emissions, we still need to adapt to a changing climate. So this creates opportunities, and it's not just around renewable energy. Innovative companies are emerging and expanding their services to address challenges around food, transportation, water, energy, and resource management, and other areas that will be particularly challenged by a changing climate. So we want to reallocate capital so that we're investing in companies that are providing these solutions to the climate crisis while lessening our exposure to risk. So what does this actually look like? At Impax, in addition to offering fossil-free funds, We also track the carbon intensity of our funds. And in several funds, we've replaced those fossil fuel names with energy efficiency companies through an approach that we call smart carbon. We've also engaged with all companies in our global funds in some of the most carbon intensive sectors, so sectors like materials, and we've urged them to establish science-based targets for emissions reduction and to undertake better climate risk reporting and scenario analysis. We're also engaging with companies around physical climate risk and requesting location-specific data of company facilities so that we can better assess what the location-specific risks of extreme climate events pose to companies. Finally, several of our thematic environmental portfolios, we measure the net environmental benefit that's derived from the activities of companies across several key areas. And that includes carbon emissions avoided, water saved, waste treated or avoided, as well as renewable energy generated. Now, this data is not readily available, and it does require us working very closely with companies to determine the environmental impact of their operations, the environmental advantages of their products, and comparing that to a business as usual scenario. So clearly, climate change is a very complex issue, and so it requires a very comprehensive approach.
Thank you for that comprehensive answer. It is really deep. I think it goes to show the amount of work that it takes to really dig into the weeds on this. Lenora, any thoughts to add to that?
Yeah, I think I'll take this from a different perspective because Heather did a fantastic job of answering that question. But I think if we view this at the portfolio level, when we construct our own individual portfolios, by not investing in fossil fuel companies, while that makes us feel good and not supporting these types of companies that are contributing to the problem, you have to ask yourself, is this really driving positive change? As Heather mentioned, is this really facilitating the transition, the energy transition that's underway? So really what's important that you do, obviously we don't want to invest in fossil fuel extractives, but look elsewhere in your portfolio. The other companies that you're investing in, where are they sourcing their needs from? Are they working towards lowering their carbon footprint? Are they looking towards sourcing their energy needs from renewable sources or use energy more efficiently? So I'd encourage you as investors to also add that into your analysis, if you will. And then also, are you investing through asset managers like Impax and like Calvert that do engagement on these issues? Because we do engage with companies to help them do a better job at transitioning to using renewable sources or using energy more efficiently. Heather mentioned that some companies are creating science-based targets. Well, we want to take engagement beyond creating the strategy to executing on the strategy. So we've been doing a lot of engagements with companies to make sure, okay, you've got this plan in place, which is a great step one, but how are you executing on this plan? Are you putting in incentives for the board of directors and other key management personnel, if you will, to meet these targets? And so our engagements have been focused a lot on that and helping companies in their transition to having a less negative impact on climate change, if you will.
Great, thank you. And we're going to dig into that engagement topic here in a minute as well, because that's certainly an important one. Impax and Calvert have these tremendous amounts of resources to be able to do this research on a global level, but this idea of staying engaged and looking at these ESG metrics can also be applied at a local level. Robert, talk to us a little bit about how we can apply an ESG lens at this more community level.
Sure. One of the things, Holly, I was just thinking about, when you think about what we as a community foundation do, that for the whole of our 57 years, we've been involved in the E and the S, right? We've been doing environmental grant making. We've been doing grant making to a number of social causes and just for developing communities, for supporting a number of projects like that. So I was just present to maybe not the G, but certainly the E and the S, that we've been in that business for a long time. But in terms of how that's being spread locally, one of the things that we've been looking at and taken a leadership position on is the fact that we have an affordable housing crisis in our country. It's not just in Greater Cincinnati, it's around the country, and its roots are multifaceted and deep, but it's an important issue. It's an issue that involves the young, it involves the old, it involves those in between. And because housing is such a social determinant of so many things in our lives, our health, our economic mobility, access to education, healthcare, you name it, we think it's just a critical issue. And that's one area that we've really focused in on. And we know a number of organizations are doing it. So we're doing it with grant support, but we're also leveraging our impact investment program to tackle that issue. The issue, as was stated earlier, of racial inequality and racial justice. The Greater Cincinnati Foundation, in June, our board announced a $5 million racial justice fund. It's certainly just a start, but it's an important statement to say that if we don't have racial justice, we won't get to racial equity. And so that's an important thing that we have taken on. And then education, one of the outcomes or the negative side effects of this pandemic has been that now many children, the majority of them, are trying to be educated at home, over through a virtual environment. But the issue of the digital divide that may have fallen into the background was still there. And so tens of thousands, probably millions of children don't have the equipment, the internet access, and just alone the space, the desk and the other kinds of tools that you really need for learning at home. But one of the things that Greater Cincinnati Foundation did in that regard locally was partner with CPS and Cincinnati Bell and others to set up a fund where generous individuals and companies have contributed to it to help defray the cost of internet access. And we see the same kind of thing that I'm talking about here being replicated around the country with other, community foundations that are leveraging not only their charitable dollars, but leveraging the power of our donors and donor advised fund holders. And just one fact, Holly, and I'll pass it on. Donor advised fund giving at GCF is up 43%. This year over last year, and a big piece of that are generous individuals responding to the crisis through a number of means. So I could go on, but let me stop there and see if I can pass it to the next panelist.
That is fantastic. Craig, I'm going to follow up on Robert's comment on the donor advised fund and sort of pull these together, that we certainly see how investments on a global level are important and applying it at our community level. How does Bartlett work with clients to meld the two of these together?
Yeah, Robert makes a great point, and something vital, I think, in this time of need to use some of your resources for good. And Robert mentioned the donor advised fund. Really, that's just a great charitable vehicle that you can use. You can take low cost basis stock that may have done incredibly well for you over time, and in effect pay no taxes and get a tax benefit. So there are great ways to do that, and then all of those dollars, rather than money going to the government, all of those dollars are being put to work through perhaps an affordable housing fund, racial justice. There are many opportunities likely wherever you may live to affect this kind of change.
Speaking of our participants from outside of Cincinnati, we've seen a number of great questions come in already on the Q&A. We have participants on from Chicago and Portland, Oregon. So we will certainly be addressing those at the end. Keep those questions coming in. And if we don't get to them, we'll certainly follow up via email. I wanted to go back, Lenore, to you to really dig into some of these characteristics of E, S, and G. As an investor, what are some of those qualities that you saw in companies pre-COVID-19 that really allowed them to outperform their peers when the pandemic did hit?
Yeah, so what we've noted that companies that exhibited the most favorable responses in embracing this concept of stakeholder capitalism were those that prior to the pandemic had operationalized the identification, measurement, and management of material, environmental, and social risk exposures. In other words, companies that had strong ESG scores or companies that were managing their ESG capital well heading into the pandemic were those companies that exhibited favorable responses, and perhaps not surprisingly, companies that had poor ESG scores heading into the pandemic have ultimately struggled, if you will. And so what are the characteristics of companies with these stronger ESG scores? Well, COVID-19, just to take a back step here, COVID-19 is a social issue. It's a global health issue. It's another example of what can be called as an off-balance sheet risk. And so companies that had already started to prepare for other known off-balance sheet risks, such as climate change, were some of those companies that have responded well. What have these companies done? Well, they've already started to reduce their reliance on fossil fuels or source their energy needs from renewable sources. Other characteristics that we noted were companies that had a demonstrated history of treating their workers well. And in some cases, these were companies that had embraced a diverse and inclusive culture. And we know from academic research that companies that embrace a diverse and inclusive culture are less vulnerable to groupthink, are more innovative, and better at decision making. And so when you combine all of these factors together, these characteristics gave these companies the ability to navigate through this crisis and prove to be most resilient.
Thank you. You mentioned earlier this idea of engagement. Heather, I'd like to go to you, and if you can just talk about how some of the larger ESG-focused investment managers are dealing with positive engagement, and how are you all working together?
Sure. Well, delivering strong investment performance is critical, but we also want to deliver impact. And so engaged shareholders can actually play a very important role in improving the financial and the ESG performance of companies that they're invested in. So we try to influence corporate behavior to ensure that these companies are well positioned to manage those risks and opportunities arising from this transition to a sustainable economy. And we want to also encourage transparency around the most significant environmental and social issues or risks that a company may face based on its sector or its activities. So at Impax, for example, we tend to focus our engagements on key topics like equality, diversity, and inclusion, climate change, and sustainability reporting. And as investors, we have several tools that we can use to do this. So we conduct engagement, as do a lot of other investors, primarily through direct company dialogues. And that's just what it sounds like. It's reaching out to a company and talking with their management team about sustainability issues. But we can also use more formal processes like filing a shareholder resolution or voting our proxies. And for us, no matter the process, the goal is always the same. We want to have a conversation with the company to better understand how they're thinking about and managing these material ESG issues. So we also regularly collaborate, as you said, with other investors like Calvert in the industry. And we do that through organizations like the 30% Coalition, where investors with over $6 trillion in assets under management have come together to advance board diversity at US companies. This group has reached out to hundreds of companies since it was founded in 2012, and over 300 companies that it's engaged, collaboratively have added women to their boards since we first started the engagement. So having multiple investors involved in an issue can really elevate the issue at a company, and it allows us to reach more companies than we could on our own, including companies that we might not own, because again, the goal is to move everyone forward and create positive progress. I think an important point to raise, though, is that successful engagement with companies requires persistence and it requires patience. So engagement isn't over in one step or one meeting. It can span months or years, but by building these long-term relationships with companies, we're well positioned to learn from one another to address new sustainability issues as they may emerge.
Lenore, following up on that, do you have an example that you can share broadly where engagement really helped a company take a leap forward that maybe they wouldn't have done if it weren't for the push of outside investors?
We have all sorts of examples that I can share with you, and one of the follow-up items that we'll be forwarding is a piece called Tools of Change that has many of the examples, because I can't specifically name companies here. But maybe, Holly, is there a specific theme you want me to focus on? Because I could really talk about anything.
Let's talk about an environmental change where a company had to, just following up on Heather's point there, either environment or diversity perhaps would be two good ones.
Okay, sure, absolutely. So like Heather, we engage. It's a powerful tool that we use to drive long-term shareholder value, performance, and positive global impact simultaneously. So we go to these companies and we point out how they could identify a financially material ESG risk that they should do a better job at managing, or a way that they can capitalize on a financially material ESG opportunity. So we basically show them where they rank and score and make some suggestions. So we're making the business case. As Heather mentioned, often these are long-term engagements. And so we want to make sure that they keep inviting us back to the table, which means that we have to come with meaningful information specific to their particular company. So we had an engagement that goes all the way back to 2011 with a very well-known e-commerce company that we probably all shop at in this current environment. And they did not have a climate policy going back to 2011. So we had to file a shareholder proposal, which is essentially putting a proposal on the ballot and then hoping that other shareholders support that. So as Heather mentioned, we will often vote in coalitions, if you will. Well, when we put this on the ballot, 20% of this firm's shareholders agreed with the proposal that this company should start developing a climate policy. But that wasn't enough, so we had to persist, as Heather mentioned. So we filed another shareholder proposal, had to get another 20%. Well, finally, after that, they did decide to form a working group, if you will. And ultimately, we started focusing on where they're sourcing their energy needs for their massive data centers, which are the size of city blocks. And at the time, they were sourcing those energy needs from dirty sources. Well, due to the pressure that we put on and the engagement, as well as that of other investors, they ultimately have started to transition their business where 50% of their energy needs are coming from renewable sources, and they're working towards achieving 100%. So that's just one example that I can share with you there. But in that document I mentioned, there are all sorts of issues that we've worked and we've driven positive change on, including gun violence, the opioid epidemic, human and labor rights, diversity and inclusion, and many others. And so as investors in Calvert, you can be part of that engagement effort that we make on all of those issues.
Very neat. Thank you. Robert, I wanted to go back to you and talk a bit about some of the tools that you are using to help enhance best practices, sort of engagement at a local level, if you will. And for those participants outside of Cincinnati, what should they be looking for in their community foundations or in their local nonprofits in terms of tools to use for engagement?
Well, mentioning tools, Holly, let me first talk, if I might, about a project of the Women's Fund of Greater Cincinnati Foundation. So we have a Women's Fund, and it does a phenomenal job of looking at many very difficult issues through a gender lens, and that's extremely helpful. One of the powerful tools that they've developed is an employer toolkit. It's available on the website, and I know you'll provide a link to it, as follow-up. But this toolkit is phenomenal. It helps employers, nonprofit, and as well as for-profit employers, to look at a number of issues that help with retention, reducing turnover, which means dollars. When you have employee turnover and you're paying to train over and over and over for positions that you don't retain, that becomes a drag on the bottom line. But they also give great advice around how to spot things like gender-based violence and others that contributes to issues of retention, especially for female employees. So the employer toolkit has been very well received, and it's been used nationally. So this is something that anyone on the call who's interested could take advantage of. But other tools that we've used, we're looking at when we get reports. For example, there are job reports about these are the fastest growing industries in the future. Well, again, the Women's Fund has said, let's disaggregate that data based on who is employed in these various jobs. And what you find out is that out of at least, I was talking about locally in the last report, that more than 70% of the fastest growing jobs were jobs predominantly held by women, but they almost all paid less than a living wage. You see, so it was growth in employment, but not the kind of employment that is going to be sustaining to help with family sustaining employment, as I could say. And then another thing that we've been doing is stepping up our engagement around advocacy. I'll use that term. And supporting some initiatives that are important for the community, whether initiatives to support, childcare and extended daycare, initiatives to say we should not ask on jobs about salary history, because we know historically there's a wage gap between men and women and between minority population and non-minority populations. And asking that question puts individuals from those groups at a disadvantage. So the job should pay based on the requirements of the job and not based on who's applying, and if they've had a low salary history, not pay them commensurate with what the job should pay. So those are just a few of the things that I think that we've been doing in addition to the things that I mentioned. And then we've been working with a number of nonprofit partners on these issues to bring forth the disaggregation of data to work on these policy initiatives.
Great, thank you.
Sure.
One of the questions that's come up a number of times down in our Q&A relates to the topic of diversity and the type of data and metrics that investors should really look at when considering diversity. Heather, I know that this is an area of expertise for you. Can you touch on how Impax thinks about that?
Sure. Well, as Lenore touched on earlier, research has consistently shown that companies with greater diversity in leadership, companies that use the talents of the entire workforce, companies that eliminate pay inequities, really stand to reap the benefits of better company performance, increased innovation, enhanced productivity, and better employee retention and satisfaction. As we've also talked about, during the disruption caused by the pandemic, these companies have also been more resilient. Now, on the other hand, companies that don't proactively embrace diversity and inclusion, or whose cultures enable or ignore discrimination and harassment, those are the ones that are putting themselves at a clear disadvantage. They won't attract and retain the best workforce, employee productivity and morale can suffer, and reputational as well as legal risks, can arise. So based on these strong correlations between diversity in leadership and company performance, Impax created a first of its kind index comprised of the best companies in the world when it comes to advancing women. And we've done that using our own proprietary gender analytics process and gender scoring. And that index is really designed to capture the benefits and the returns associated with gender diverse leadership. That being said, across our funds, we use a variety of quantitative and qualitative diversity indicators in that fundamental ESG research that we conduct. So some of the proactive policies and programs that we tend to look for that we think create accountability and transparency and are levers of change at companies include the gender, racial, and ethnic diversity on the board of directors and executive management. We look for disclosure of workforce composition, including new hires and attrition rates by gender, race, and ethnicity. We look for evidence of proactive goals and targets to increase gender and racial diversity, as well as programs to develop a diverse talent pipeline. So recruitment efforts or development programs that are aimed at increasing representation from women and minority groups. Finally, we're also looking at commitments to pay equity. The wage gap was just mentioned. We want disclosure of pay equity data and efforts to close unexplained pay gaps. So, you asked a question about data availability. We've certainly seen company disclosure on gender-related indicators improve in recent years, but there's significant gaps that remain, particularly around pay equity, which is one of the reasons that we've focused a lot of our company engagement on that topic. But there's also significant gaps in reporting around race and ethnicity, and I'm sure that you've all seen this in the news recently. only about 4% of Russell 1000 companies, so the 1,000 largest companies in the US, provide a full accounting to stakeholders on employee demographics across gender, race, and ethnicity. So, I'm hopeful that the pandemic and calls for social justice will actually be a catalyst for more positive change here and lead to a more honest accounting from companies of where they are on their diversity journey, so that we can have a better understanding of where they are now and where they're moving towards the future.
Craig, how has Bartlett continued to evolve on our diversity journey? I think that's a great word that Heather used there.
Yeah, well, rest assured, we have a tremendous amount of data. There's no shortage of that, and that's fantastic. Transparency, accountability are going to be the bedrock of this catalyst that Heather mentioned. And so we use whole hosts, Impax, Calvert, Morningstar, to understand how our companies, so the investments that we're making, individual stocks or funds, how do they stack up? How do these companies look on a relative basis on all these metrics that Heather mentioned? And it's important for us to see that, the numbers don't lie, so to speak. And so when we can match all of those things up with the investment side of things, we know that what we're doing for you, our clients, is actually having a meaningful impact on things. We clearly, as a firm, these are very important pieces of our ethos. We live by what we call the Bartlett way, and number 2 on that is be inclusive, and it falls just behind teamwork. So we have a number of people who are involved in multiple things here locally, globally in some cases, and we have groups like our Emerging Leaders Group, our Culture Committee, diversity to help really enhance our diversity and inclusion policies and make sure that we are at the forefront of this change. And we're doing what we say we want to do. Many of us give our time with organizations like the University of Cincinnati's program that encourages financial literacy in local elementary schools, right? Especially in underserved communities. As Robert highlighted, really many of these communities suffer from a range of these issues, and it's incumbent on us to help them. It's for the greater good, and ultimately that's where we are trying to help. It's on a personal level, and it's also on an investment level.
Great, thank you. We have lots more questions flowing in, so I'm going to wrap up here with our panelists. I'd love for each of you just to share a soundbite for us as to where ESG is going in the future. Where do you see us 5 years from now? Heather, let's start with you.
Sure. Well, I think that the growing demand for engagement and impact is going to continue. Investors increasingly want to know that their investments are making a difference. 2 of the most popular strategies at Impax right now are thematic strategies addressing the environmental challenges that we talked about today, as well as equality and inclusion. And these are 2 sustainability issues that are not going to go away. Contrary, climate change and equality, they're only going to become more compelling, urgent priorities in the years ahead. And I think investors are going to insist across a range of sustainability issues that their investment dollars be part of the solution to these global challenges rather than part of the problem. I'm guessing that folks dialed in today because they're interested in ESG and they want to educate themselves about, aligning their investments with their values. And so I'd encourage everyone on the call to work with Holly and Craig and the team and, work to make some alignment in your portfolio on issues that are most important to you. Because I know in times like these, it can be hard to believe, but we really all can be part of the solution and have a role to play in moving towards a more sustainable economy.
Thank you. Robert. Mute.
Sorry. What I would say, Holly, is if Greater Cincinnati Foundation, in partnership with United Way and Interact for Health, commissioned a report through PolicyLink called All in Cincinnati. And what that report found is that if we were able just in our region, just in greater Cincinnati region, to eliminate disparities in income and opportunity based on race, that our local economy would be $6 billion larger. That $6 billion of more, $6 billion new dollars to invest in businesses, to start businesses, to grow, to create opportunity, to create wealth. So as my CEO often says, that diversity, equity, and inclusion is the superior business model. So an embrace of ESG locally would create opportunity for all of us.
And to think about the impact of that, Robert, when you multiply that by every community across our country, that's an amazing amount.
Yes.
Lenore.
Yeah, there's many ways I could take this question. I think when we think about the future, interest in this space is only going to continue to grow. I mean, we've seen that, Craig quoted that, year-over-year growth, and this pandemic is really accelerating interest in responsible investing from the impact investor that's mobilized and energized now more than ever because they recognize that the pandemic and civil unrest is exacerbating many socioeconomic and environmental challenges, and they do want to be part of the solution, and you can be part of the solution. So I'd encourage everybody to be thoughtful about the role that we play as individuals, because let's face it, every dollar that we put out into the world, if you will, it has an impact. So be thoughtful in terms of the companies you support, the products you buy, and the investing portfolios that you create. And the more that we do this, the more that we can, if you will, leverage the power of capitalism to drive change in these areas. Increasingly, the corporations are playing an important role in addressing many of these issues that we all care about. So it's really important that we try to reward those companies with capital that are headed in the right direction, and ultimately try to avoid and not support those companies that are creating the very problems that we're all trying to solve here. And so I think that we're going to see more of that as the years come.
Absolutely. Craig, finish us off here.
Well, my distinct hope is that it may take longer than 5 years. Change is incremental, but my distinct hope is that the ESG moniker, in effect, goes away. That it just is. That an ESG focus is just simply good business, and we're going to continue to see a shift away from, just screening out the worst performers to moving and partnering up with local organizations, national, global, to get behind this idea that action and accountability are the two forces to making this work. And seems like right now we have a critical mass for that to accelerate this process of positive change. So I see big things for this, and I also see just continued success with this. You do not have to sacrifice performance, we believe, to have your positive values produce strong investment results, which again, the more we have, we're talking about trillions and trillions of dollars in lost GDP due to systemic racism. Let's put that back into the community and see what that can do. And we all know that is the right thing to do. So my hope is more people will continue these conversations. They are happening more and more day after day. And I thank all of you for being a part of this. And you can see you have a lot of partners. So thank you.
Thank you. Thank you all so much for your insights, and we're going to continue to leverage you as we head into Q&A. I have two questions here related to the government, and we've seen this shift, and we've talked about the shift here in major corporations embracing ESG. Do we see a similar shift in government? And along those lines, as sort of a follow-on question, we've also seen sometimes the government inability or lack of capacity to engage on many of these national and global issues. Is that a permanent change that you think we see from our government? And if so, how can corporations effectively replace government institutions? So let's talk a little bit about that mix and blend of government versus private institutions. Lenore, why don't you kick us off?
Yeah, so it was interesting, obviously, with the current administration, there's been a lot of rollbacks on all sorts of regulation. What's been interesting, though, is that despite that, companies are still embracing various strategies to make them more sustainable. And they're doing that because they themselves are recognizing that how they manage their ESG capital matters to them. There was a report recently put out by Merrill Lynch, I believe, that as much as 70% of a company's valuation is based on how they manage their ESG capital. So they're making these changes because they recognize it's in their best interest. And increasingly, they're making these changes because all of us are making choices to support them. Increasingly, as the millennials are getting into the workforce, they are making employment choices based on how companies manage their ESG capital. And increasingly, we're choosing to invest in companies based on how they manage their ESG capital. So as I mentioned before, the more that we can reward good companies, the more we can give an increasing role of the corporation in society. I think another two ways that I can address this question. Our CEO recently noted that no matter who wins the election, it's not going to be the federal government. And when he went on by that, he basically said that our trust in government is so eroded that we actually feel that the way change is going to happen is through companies, even though we are also recognizing that there are many companies that have a long way to go. And that he was referencing some of the Edelman Trust Barometer studies that have been put out. I know at Calvert, we do our part to try to influence government. Both our CEO, John Stroyer, and our Director of Engagement testified at various Senate subcommittees last year, and there's more information on this in that piece, Tools of Change. But I know our CEO basically testified that for us to remain competitive, we should be forcing companies to disclose on financially material ESG factors. And if we force them to disclose on what's financially material to their business, as we know, what gets measured gets managed. And so this is another way that we're trying to push these companies to do a better job at managing these factors. And then our Director of Engagement testified at the subcommittee on the Senate and Public Works around creating more legislative incentives around climate change. So again, you can get some information in there.
Great. Craig, this question is more related to how you may manage investments and start to work in those ESG qualities over time, as Heather mentioned. One of our attendees says that she has a broad stock portfolio with many stocks that have a very low cost basis. How can she start the process of selling some of those stocks which are not as environmentally friendly or as strong on the ESG metrics and buying stocks that are stronger ESG players without paying the long-term capital gains or feeling the pain of those long-term capital gains?
Yeah, I was hoping you weren't going to put that in there at the end, but
it's hard to have your cake and eat it too, right?
yeah, for sure. I think it's a great question and certainly a very relevant question for a lot of people. And what we advise is look, I'll give you one example, okay? I can't give you a specific company, but let's just say it's in the oil and gas business. And, a year ago it was trading at a certain price, and now it's trading 50% below where it was a year ago. And if the only argument was, well, I don't want to pay the taxes, then really you're only likely to hurt yourself. Why? Because as we've all been pointing out, coming into COVID, during the COVID sell-off in the market, and now on the rebound, the ESG leaders, the companies that screen the best, have been the best performers, period. And the companies that are poor ESG have not, and likely will never, unless they do something drastic. And so our advice to clients is, okay, we understand you don't want to pay the taxes maybe all this year. Let's spread that out over some period of time, and let's work this in. But it's very important to not let the tax tail wag the dog, in our view. And so, it's a personal discussion. As you can imagine, everybody's all over the map on this. But generally speaking, we would say work this in over a period of time. And if you can, try and accelerate it, because that's how, we may put up a red flag, and we hope that you will you will work with us and take that recommendation.
Heather, a question here on the best independent/unbiased quantitative measures and subjective reviews of corporations' ESG performance. So just getting a little bit more to that data. For an individual investor, where can they turn to find some of this information?
Sure. Well, there's certainly lots of third-party ESG rating providers, and some of those providers have recently started making their overarching ratings public. So two that come to mind are MSCI and Sustainalytics. But in terms of getting into sort of the meat and potatoes of what companies are doing and what they look like, one group I would check out is Just Capital, and they have been really critical in kind of tracking company responses in real time, first to the COVID pandemic, what companies are adopting very innovative responses, how are they supporting employees, promoting health and safety and things of that nature. But they've also been tracking response to the recent social unrest and calls for racial justice. And so, that can very quickly, give you a very good idea of which companies are leading the way on these two crucially important issues, and which companies are, either silent or really falling behind and not doing much to support their employees during these times.
Great. We're coming to the end of our time, but there are just a few more questions that I want to get in here if we can get some brief responses in. We have a question from an attendee out in Oregon, and Robert, she's considering where to give her philanthropic dollars and deciding between some of the larger national organizations versus smaller local community foundations or nonprofits. How do you advise donors who are facing this dilemma?
Well, what I would say that, naturally we'd have a bit of a bias towards the local, not surprisingly, I would suppose, because if she wants, in addition, real-time information about what's happening in her community and how to plug into initiatives that can make a real difference that she can see locally, that is, I think that's going to be there. And often the community foundations have relationships and are aware of national trends, because we partner with our peer community foundations to share information, to share best practices. So I would encourage first to look there. And if she's not satisfied, I would suggest even that the community foundation could connect her to some national resources as well. So that would be
Thank you, Robert.
my recommendation.
We're going to squeeze in one more question here. Lenore, from a global perspective, what countries stand out as the best in creating public policies that favor ESG priorities?
That's a question that I can't really answer, but what I can do is encourage whoever's interested to pay attention to the Calvert Institute. It's something that we launched recently, and the idea is to sponsor research on financially material ESG factors. And we are doing research on the strength of corporate governance at the company level. And we actually are starting to integrate that into our research. So there will be all sorts of white papers that are published there. You can access the Calvert Institute through the Calvert website, which is being provided to you. Because yes, there is an interesting dynamic between companies that have strong regulatory proposals and then what's financially material within those countries that have strong regulatory frameworks, if you will, versus those that have weaker ones. So there's different financially material governance factors that we are looking to integrate into our research process. So it's quite cutting edge and innovative.
Thank you. So we didn't get to all of the questions here today. If you did provide your name, we will follow up with you afterwards. We wanted to thank you all for joining us here today, and please keep an eye out for an email that will be coming out following this webinar. It will have information from each of our panelists here today if you want to dig deeper on this topic. We'll also include a link for you to provide a really fast survey, and we'd love for you to fill that out so we can continue to improve our event and digital event process. We'll also be featuring a recording of today's video, and that will be available next week. We'll share that out with all of our registered attendees. So if you have any friends who weren't able to join us here today, you can share that out with them. Thank you again for joining us. and we look forward to being in touch with all of you soon. Take care.